going on, everybody? 360 Digital Closing Bell here. I am your humble correspondent, Michael Tanner, joined for our Week Ahead podcast here on this beautiful June 29th, 2020. As always, I'm joined by the executive producer of the show, the purveyor of the show, and the director and publisher of the world's greatest website, oilandgas360.com, Stuart Turley. Stu, how you doing today, my man?
I'm doing fantastic. It's going to be a fabulous, busy week.
Each week seems to be getting busier than the last. So yeah, I can totally agree with you. If you guys are listening to this, it is sometime on the week of June 29th. Excuse me, guys. I'm playing a little slow today. Had a little traveling. I'm actually coming to you for the first time from an undisclosed location in Huntington Beach, California. So getting a little beach on this weekend, which is nice. And if anyone's wondering how Southern California is treating COVID, it was wild. Everything's open, no masks. I mean, you want to talk about a V-shaped recovery, Stu. I mean, I'm bullish on oil prices solely because I've been down here and seen some activity going on. It's actually really weird. Considering it's California. No, it's weird. It's California and nobody's wearing a mask. It's odd. Colorado's a lot more strict. I feel a lot more, you definitely are wearing a mask everywhere you go in Colorado. Here it's wild. It's the Wild West.
That's funny.
It is funny, but
the bars down.
Yeah, no, exactly. So this is our Week Ahead podcast for June 29th, episode number 29. We have a great show for you guys lined up. We're going to chat about it's the new WTI, and it's not really WTI, the replacement for WTI benchmark that S&P Platts and Argus are putting out. It's a new waterbound crude. It's going to be very interesting. It sort of just makes me laugh. We'll also check in on the levels for crude oil, as always, in Commitment to Traders. And as always, look at how the thrashing for the 360 official, non-official fund. But first, guys, I need to tell you about my friends at Adamantine Energy. These guys are the ESG oil and gas experts. If you have any questions and you're an executive and you're not implementing ESG, corporate social responsibility, or any of this stuff into your business right now, I mean, you can hear us pounding the desks for weeks. It is the only way to get capital in today's game. I highly recommend calling Adamantine Energy, and specifically Tisha Schuler. She's the former CEO of the Colorado Oil and Gas Association, and she's helping companies navigate all of your corporate social risk and how to future-proof against all of the things. I mean, there's so many different ways in which she can help you, from strategic planning to help you with ESG, executive decision-making, to actually rolling out and implementing plans. Because a lot of people think, okay, well, it's easy to spin up a page on my website, but how do I actually implement these programs into my company? That's what Adamantine Energy's specializes in, not just the high-level architecture, but the implementation of that issue. You can find out everything Adamantine Energy at www.energythinks.com. You should also subscribe to Tisha's Both Things Are True weekly email series, where she's going over this. It's the name of the whole email series, where she'll send you one email a week. And trust me, I highly recommend getting on that, because your competitors are reading it, because it's talking about everything it's basically a peek inside her mind, the leading ESG expert, in my opinion. And it's no better way to get information. You can sign up for that newsletter at www.energythinks.com. You should also subscribe to this podcast, the 360 Digital Closing Bell, iTunes, Spotify, or YouTube. It's the best way to stay up to date with all of your energy market news. I would highly recommend checking out our Digital Ticker show that's live on YouTube every single day at 2 o'clock. We're attempting to roll out a new studio setup, Stu, but it's going absolutely terrible. So hopefully we can get off Zoom here in a little bit and get moved over to sweeter software. We've been toying around with it. If you've seen some of our commercials we've shot, you have an opportunity to see them. But majority of you do listen here via podcast, so we're always going to be making sure that sound quality continues. And by the way, if the sound quality does stink, please just email me and let me know. I've had some people reach out. I've made some changes over the past 10 episodes, so hopefully the sound quality is getting a little better. We are on the road this week, though, so hopefully the road setup sounds really good. You should also check us, Entercom and Oil and Gas 360, out on all of the social platforms, YouTube, Twitter, LinkedIn, Oil and Gas 360. Find me and Stuart on LinkedIn, the best at me. We're not hiding anything. If you want to connect with us, mtanner at entercominc.com. You should also subscribe to Entercom's Energy 360 Network podcast, which is the place for energy thought leadership. We have 3 interviews coming this week for them, which is really awesome. Monday, I don't want to mess this up, Stu. Monday's Energy Net, Tuesday's Data Gumbo, Thursday's Garrett Falk Jones. Cool.
Yes,
so Monday we have the experts at EnergyNet. These guys buy. If you want to sling minerals or sling oil and gas products online, go to EnergyNet. I mean, it was a great conversation. We sat down with Gus and Anesthesia over there. Tuesday, Stu, we had a fascinating conversation with Andrew Bruce, who's the CEO and founder of Data Gumbo. Blockchain, man, that stuff, as you mentioned, sometimes you just want to curl your head in the fetal position when you hear about that stuff.
I love, and Andrew made it so nice. I really appreciated the ROI that he has put his reputation when he says, we're not going to charge you for you to install it. No, we're like, wow.
Install and the cost savings. I mean, I don't know if it was $1 million a minute that he was saving, but it was a minute. I thought it was like per day, but it was a minute.
When you're drilling a rig and his blockchain technology is so good, he could save $1 million a minute. That's big in OpEx money.
Well, if you're listening to this now, you should be calling Andrew Bruce at Data Gumbo. Get spun up on him. It's unbelievable. I thought that was not hyperbole. I just thought I heard it wrong, and I was like, $1 million a minute. That sounds ridiculous. But no, it's true. Holy smokes.
I had to, Bruce, Andrew, you need to go back a little bit.
Yeah. That must have been the part where you. And then on Thursday we have Gareth Falk Jones, who's more of an international renewables expert, and I enjoy talking with him. His accent was thick, which is awesome. He's probably the most he is the international man of mystery, if you want to actually put an actual name to the phrase. This dude's from South Africa, lives in Spain, lived in all different countries in Europe, and he has a Chinese wife. So you talk about the international man of mystery, Gareth Falk Jones. Great interview on renewable stuff, and he's really, I would call, and I think we can say this, he is what we would say a reasonable renewables activist. He understands what some of the limitations, at least now that we're seeing, correct?
Absolutely, and he also ties finance to it and says you got to use the best financially, the most economically dollar per kilowatt.
Yeah. So please check out all of that Energy 360 podcast, iTunes, Spotify, wherever you get your podcast. All right. I think that's enough clerical work. Really we ran this story on Thursday or Friday on the Oil and Gas 360 news desk. And I kind of just, when I first read it, it made me really laugh because there's just some hilarious quotes in there. But really, it's a very interesting shift in the oil and gas business. I think everybody understands that, when we saw negative $37 oil price, oil wasn't really negative $37. It was really it really was a result of how that WTI contract is really structured. And because of that sort of prompted a lot of new thinking on how do we take maybe something that's a little more outdated and change it. And so one of the things that if you've been following, not specifically us, I don't think we were the first to this, I don't think oil and gas, I'm not going to say we were the first on the case, but we were definitely on the early bandwagon of, this has to be a better way to benchmark crude oil. I mean, we're seeing crude should never really go below zero. I mean, I guess it could. Theoretically, anything can trade below zero, but it really shouldn't do what it did on that day. I mean, we're talking about an unbelievable historical collapse. There are people that absolutely got wiped out. And so both S&P Global Platts and Argus Energy, which are basically two large oil and gas research firms, have decided that they're going to release, and they actually released them on the same day. Isn't that funny how it does that? It's like McDonald's and Burger King coming out with the McChicken within 2 days. It's like, do you have inside spies or something? It was really funny. You're reading the articles like on June 25th, S&P dropped their new benchmark. On the next day, Argus dropped their new benchmark, which is the exact same name. It's unbelievable. Unbelievable. Corporate espionage. Business is probably booming between these two people.
Hey, Michael, that's like other people dropping interviews the day before ours.
Oh, talk about corporate espionage. That means we're on to something. It's a good point. It's exactly like that. And we know who you are. And trust me, we're watching and we know we're better. That's okay. But now you get me sidetracked, Stu. Sorry, but both S&P and Argus, they're releasing new benchmarks for the price of crude oil. And what's hilarious is they're both calling it the same name. At least they're not calling it the Energy Expert Network, Stu. That would really get us. The S&P and Argus, they're calling it the same thing. It's the American Gulf Coast Select Contract. I'm telling you, it's legitimately the symbol AGS. So they're going to differentiate by saying S&P AGS, AGS for Argus. And really what the differences, or to kind of give you an idea, the Platts AGS. I'm just going to pull this from the article because I think it's the best way to talk about it. The S&P Platts AGS will represent the value of waterborne light sweet crude loading from loading FOB U.S. Gulf Coast 15 to 45 days in. So that's huge right there. So now they're projecting 15 to 45 days in the future. It's not talking about current supply. That's one big shift right there. A key goal is to avoid price distortions that sometimes arise from Cushing, which is more than 500 miles away from the Texas export hubs. The Argus AGS is initially going to cover the Houston area, but is expected to expand to cover Corpus Christi, Louisiana, and new sources of Midland quality WTI products, they said in an announcement. Argus Index will publish an outright price, but this is key. They're going to also have a differential to Cushing crude contract to accommodate those who are still hedging on that. And so basically what this comes down to is, we all know that WTI is quoted, when you go look at a quote chart, what's the price of oil? Boom, we quote WTI. Well, S&P and Argus are trying to say, what's the price of oil? Boom, let's look at AGS. And there's some structural differences to the way both of these contracts are traded. And really the question is, I guess, why are we going to all this trouble, I think? Because, okay, WTI doesn't work. It only doesn't work for one day. Why do we have to completely switch up the contract? Well, and as the argument goes, sorry, we're getting, things are lighting up here on my end. And the argument goes, that Cushing is really a bad representation of actually what the price of oil is. There's a couple of reasons for that. One, it's a bottleneck. There's the location of pipe. It's really a bottleneck. Cushing is known, Stu, as what is it? The pipeline. What is that famous photo? The pipeline crossroads capital of the world, or something like that. Is that what they got printed on there?
Yeah, it's an amazing facility when you walk through it.
It really is. 91 million barrels of oil storage. You have so many different pipelines that come through, and it really creates this central hub where you can price. And what's interesting is that WTI is, as we know, it stands for West Texas Intermediate, and it's priced out of Cushing, Oklahoma. And WTI is a conglomerate of what happens at Cushing. But what's interesting is when you look at where the location of the pipelines are that come into Cushing, you kind of start to think, wait a second. This seems odd, because obviously the Basin Oil Pipeline, which is one of the biggest pipelines owned by Plains All American, flows from Wichita Falls, Texas, all the way to Cushing, and the Centurion Pipeline, which is the big Permian Basin pipeline that hooks up a lot of those different counties down there in Midland. Those two obviously flow into Cushing, but that represents only 6% of the oil that flows into Cushing. Otherwise, I mean, look at this. You've got some Oklahoma, you've got some Trans-Canada flows in the Keystone Pipeline. Remember the Keystone XL pipeline? Well, the Keystone Pipeline flows in there as well. That comes from Alberta. We've got Mississippi and southern Kansas, the Mississippi Line Pipeline, which is another Plains All-American coming from Oklahoma. I mean, I would go look at you can just, this is on Wikipedia. I would go look at the inflow locations for Cushing, and it kind of gives you're like, wow, wait a second, like a lot. This is mostly Oklahoma oil. This is a lot. This isn't as much Permian Basin oil, because a lot of that oil, specifically in 2016 when the export ban got switched, Texas started exporting a lot of its crude, because light sweet crude is very, very, very desired on the marketplace, and so that's sort of the thinking behind this, and when you look at so when it comes down to what all those inflows come into Cushing, that's the difference. Instead of using Cushing as a point to market, they're going to use what's called waterbound crude. So what the American Gulf Coast select, instead of taking oil flowing into Cushing, they're going to follow specific pipelines that take West Texas crude and transport it to export facilities all along both in Texas and the Gulf Coast. Specifically, our boy Sean Strawberry, CEO of the Port of Corpus Christi, they are going to be one of the biggest takers and are probably going to be on the forefront of marking these contracts, Stu, because they're, especially on the Argus contract, the Argus AGS is specifically using Corpus Christi as their pricing hub to start out with this as they expand along the coast. And you ran a story, what was it, 2 weeks ago, on their increase in storage?
Yeah, they are increasing their storage dramatically, and I bet it's because of this.
Yeah, now, we know exactly why.
Here's the danger, Michael, when you think about running a pricing mechanism of export. you cannot guarantee. You just said that you're going to be 30 days in the future, 40
Mhm.
days. You can't do storage in that long of a time period in export pricing. This is got some flaws in it. You
Okay.
need to almost do a combination of Cushing and the export. There is too many variables for you to even think about using it this way. I also told you a little bit when we talked about on Friday, you have the article on
Mhm.
Brent. Brent is
Yes.
also under attack. And so when you not attack, but there's so much the Russian gas pipeline. Europe is tired of being told how much they're paying for gas.
Mhm.
Then you also have the Urals, the Ural gas coming out of
Mhm.
Russia. They're now turning it away because they want $4 more per barrel on top of Brent. So this is all coming about around the world. This is a world retalk on money.
Yeah,
So you need to be
and how
careful.
we price contracts, I totally agree with you. And what I just find funny, and kind of to sort of the only take I have on this is, one, I don't know how quickly this is going to be adopted by the overall community. I don't know. I don't know if you're ever going to see CNBC quoting American Gulf Coast Select before you see WTI. I just don't know if that's going to happen. I just think it's too ingrained. It would have to be a complete systematic shift, and you would have to have large oil companies get on this path. And as we kind of get into what this means for the energy business, you'll sort of see why this stagnant. But um, what
Now,
I just find my second thing when I read this is it just makes me laugh, Stu, because I I think a lot of people Monday morning quarterbacking is one of my favorite things to observe, because I think we did this with a lot of the coronavirus stuff. Hey, looking back, we should have done this. I think people standing today look back on WTI and what happened when oil went negative and say, well, it's clear that WTI is sort of a flawed, using Cushing as the benchmark is a flawed practice. But nobody was saying that before. No one was thinking this was a flaw before it happened. So now we have revisionist history happening, where you see quoted in this article, and this is what gets me. This is Evercore. These are those guys who have been Evercore, for example, have been really, really good on executive compensation, the egregious executive compensation that is sometimes happening over this. They have been the ones that have been on this. But listen to this. Listen to this quote, Steve. This is what kills me. So this is James West, an energy analyst with Evercore. This is long overdue. We've viewed WTI as an outdated crude price benchmark for years. No, you haven't. You're now just trying to make it look like you've been on this game for 3 years. Nobody's been. I have seen zero on this topic for 3 years now, because it really hasn't been an issue. Cushing's worked just fine for how the energy business worked. All of a sudden, we had an unprecedented, and we've pretty much banned saying that word, but we might as well say it one more time. An unprecedented event happens. Now, all of a sudden, we have to pretend that for years we were thinking we should change it. No, we can all just say, hey, this happened, and we're going to change our opinion moving on. I'm saying that. I wasn't thinking this before COVID. Oh, we need to change. It was just something that wasn't on my mind. There's so many other things that are there. So I challenge them. If there are articles out there that you can find where people are quoted as saying this needs to happen pre-COVID, send them my way. mtanner@enercominc.com. I don't know if you'll find them, Stu. I don't know if you'll find them. These quotes just kill me. Those James West guy probably thinks he's brilliant.
now, I will say, Michael, you and I have been talking about the new price differentials in natural gas in Henry Hub versus the other hubs.
Was it
And
before COVID, though?
that is correct. And we were talking that there is a very good logical reason for it.
Mm.
We haven't even begun to talk about the reasons for
Yeah.
WTI and everything else. There is a trackable natural gas in Henry Hub and in the other hubs
Yeah.
in the US. There is a reason for that. There's Anyway. Thank you.
No, and you're alone. I think we fall along the same point here. That's I think this is a really good thing for the industry, and I'm definitely going to be following this index. We're going to have this index on the news decks, because I think I would love to see this become bigger, because I do think there are problems with Cushing. But I'm not going to lie and say I was thinking about this 6 months ago, and I
No,
don't
but if
think
we track it, and you look at data, you can evaluate if it's being tracked or being created correctly.
Yeah, no, and we'll take a look, and specifically S&P is not. We will make both of them into a differential from WTI. The problem is S&P is trying to get away from WTI, so they're not even quoting a differential. Aegis or Argus will give us a differential, but they're both called, again, American Gulf Coast Select, new thing. Really kind of to wrap this up along this, like, what is, the question you guys might be asking, well, what does this mean for the energy business? And I just like to kind of cover what, whenever there are new regulations, new things rolling out, how does this touch each part of the business? If you're an E&P, doesn't really do much for you, to be honest with you. You're still negotiating your contracts with your marketing companies, and they set their price based on API levels, and then really WTI is quoted based upon marketing companies. I mean, marketing companies are Plains All American, these companies that own these pipelines and sell to refineries. So you're still negotiating with them. It's going to be interesting to see how those prices follow WTI. I would, again, that's something we want to cover, because I want to know what that differential looks like as time spreads and how closely or not closely these indexes follow each other, because then you might see different segments of companies moving. If these don't follow each other that well, you might have a group of companies only using this one, and then we don't really want a fractured business. We really want everybody to use the same one, because it just makes it easy. But so that's my only fear with this, is that we're going to have two different swaths of people using different ones, and we're always going to have to figure, what number are you quoting? You quote AGS or WTI? You know what I mean? Like, it'd be really nice if we could all move at one. But if you're an E&P company, not necessarily changing, and your hedging is still done in WTI NYMEX contracts. So until CME or until there's quotable contracts that you can hedge with, or products that you can hedge with, it's not really going to touch your business that much. If you're an analyst and you work in the energy analyst business, great. It's just another index for us to follow. And that's pretty much all I'll say. Yay, just another index and more research we can do. Seems how funny how that always works. If you're a trader, this is where I think the biggest movement comes in, specifically on the physical side. This is where, because this quote AGS is American Gulf Coast Suite, and most of the oil that's slung in America is exported from Texas, you're going to now, I think, seeing this price is already going to be I see quoted in two contracts that were being sent out by two marketing companies down in Texas right there. But I think you're going to begin to see this price quoted out in physical transactions, because with large oil physical trader counterparties, because you can have these agreements over the counter, so you can really set whatever terms you want, and we just can use this as a benchmark. And I think specifically the people who are going to love this are going to be physical offshore large volume traders, because this is going to give them a much better idea of what their volume is worth. And I think it's going to be not as, I think, volatile. I think that's really the key. I think you're going to see Cushing and WTI continue to be very volatile. I do not think AGS is going to be very volatile. I think that's probably part of the reason why, and probably why you think the way you think, Stu, where there needs to be some sort of blend, because it'd be very interesting to sort of overlay these prices between each other on a daily basis.
Oh, I agree, man. You explained very well.
And then if you're a day trader, I always like to include our day traders out there. If you guys are slinging Crudella on the side, nothing's changing until the CME really rolls out a contract that we can sling. We're pretty much out of luck trading it, which is good. We all know how WTI trades. We have to relearn a whole new structure trading. It would be tough talking about trading a whole new product, and that'd be really talking about market settings. So it'd be super interesting. But yes, new contract and pricing coming up. Very interesting how this sees. We're gonna keep following this, because I think this could become interesting. I mean, this gets picked up by some of the industry. I mean, it's gonna be very interesting. If you well, what contract are you quoting? And it's just I'm gonna have to throw people through a wall on email. But if that starts happening, I will snap my laptop in half. If I have to start asking people what contract they're talking about for just the price of oil, I will snap my laptop in half. I can quote you that right now.
I will not leave my laptop around you.
Please don't. Anything else on this subject before we move into the oil prices for the week?
No, well done.
Thank you. Cool. Well, let's go ahead and just move into the levels and outlook for oil trading this week. As always, this segment is sponsored by Sandstone Capital Group. These guys do insanely good research and provide all of their levels from the Energy Glimpse solution. I'm telling you guys, if you need anything done in the energy advisory, just give them a call, 949-561-1818, or check them out, sandstonecg.com. Before we move into the levels, I always like to give one thing to watch for in U.S. shale, whether it's this week or moving forward. And this is something that I think if you've been following this is why I recommend following our daily ticker show, because we run a lot more specific articles that if you're savvy enough and you watch enough, you can pick up on things a couple weeks sometimes before they drop, just because that's a lot of things. It's a lot of times how things are. They just drop. Little news items drop, and in the end, when it happens, even I don't know that it's going to 3 weeks from now be important. But then that event happens in 3 weeks, and we're able to, oh wow, we ran that story 3 weeks ago. So a lot of it comes from full circle. And we ran 2 weeks ago a story on a couple companies doing what's called non-operational management agreements, which is basically, imagine you decide to start a company, and instead of hiring any employees, you contract everything out. What that looks like in the energy business is specifically, we're going to have an executive team, generally with CEO, CFO, finance guy, probably some sort of operational control, president of operations. I don't know generally what the title would be, Stu, but basically can be a small, tight crew, and you contract everything out. You contract the drilling, you contract your completions out. Obviously, those generally happen that way, but you also contract out your production, and you pay somebody or maybe pay somebody to manage your assets. And that has been something that has been big in the small stripper game. I was at a previous in a previous life, I was an outside sales guy slinging heel systems for a company called Heel Systems. Basically, you put them in you basically put them in the heel of a well, and it helps separate your solids. They're actually really sweet. This is a free ad for Heel Systems, so check them out. And they're owned by Schlumberger now, so they're a conglomerate. So I guess we can give the man more money. But no, good company. I love their CEO, Jeff Saponji. He taught me a lot about just how do you do more of the corporate sale in the energy business, because it's different than just cold calling somebody on the phone trying to sling them digital marketing products or something. So shout out Heel Systems. But one thing I learned when I was doing a lot of that Heel Systems work, sales, was how much non-operational management are in the small mineral rights / more small private operators. A lot of them operate that way because honestly, when you get down to it, the numbers just look better. You don't have payroll. You're not paying them. There's a lot of payroll expenses that you don't have to incur. You're just cutting checks every month to operate or to contractors. And you're beginning to see, I think, more of that move forward in the larger and larger companies. As we all know, consolidation is happening in the energy business, whether it's Chapter 11, M&As, or just outright companies just go away or just get absorbed. I think this is something over the next, maybe not week, but 2 to 3, 4 weeks. Watch for this. I think non-ops management, you're going to be seeing a lot more stories of this happening, because I just think the numbers are going to become more attractive to what if we just farm everything out, or what if we sell off everything and for our executive fee, we're just creating a basically we're just getting, it's almost like you're just getting a royalty payment off owning your own oil and gas, minerals. So I think it'd be very interesting, Stu. I think we're going to see this come up. But that's kind of the only thing I wanted to point out. I think if you want to know more, stories that happen, I highly recommend checking out our podcast that we dropped last Friday. It's going to have more kind of stories and some of the things that happened last week. Anything that you're looking for on the U.S. shale side, Stu, this week?
On the shale side, we have the Intercom team has done a lot of branding for High Crush. High Crush on Thursday and their earnings, and they had a very big loss and everything else. And then Friday afternoon, they filed for bankruptcy. So I ran the story on Thursday going, man, that's a bad looking earnings number. Next day, they are filing for bankruptcy, and we're so sorry. That's such a good operation. So good people, good operation, and they got slammed.
Yeah, no kidding. So, our hearts are out with them. What do you got on the international news desk today?
Hey, a couple of things, Michael. And this one is, I came across this one last night doing some nosing around in the world. And there is this is Russian, so I'm going to if I butcher it, forgive me.
Okay.
Belarsk nuclear power station
It's Belarus. I think it's Belarus.
Belarus? Okay, cool.
It's the name of a country, right?
Yeah. No, it's a thing in Russia. It's a.
Oh, okay. I thought, isn't there a company? Is there a? Sorry. Continue. I'm an idiot.
Anyway, it's a BN 600, and they were filing to take it to 2040. That would take that nuclear reactor 15 years past its due. So when you have that, the kilowatt per hour goes down significantly, but it would also save 33 million tons of coal of fossil fuels. So if you have people that are out there saying, hey, nuclear's bad, I think this might be something that I wish that the US could look at, because we have 98 reactors. And of the 98, I don't know how many of those are going to get extensions. And it's a lot cheaper to get an extension on a nuclear reactor if they do good testing on it. France this weekend had a nuclear reactor that they were about to shut down in France. And they're trying to get an extension on it, and all the nuclear folks are going nuts. So France has 56 nuclear reactors, and this is the oldest one in France.
Well, I mean, if you talk to guys like Alex Epstein and the experts that we trust, we've interviewed, they love them some nuclear, and they think nuclear should be the way to energy, our way to sort of energy independence.
As part of their theory, though, is also, Michael, it's kind of like the Michael Tanner law of COVID. You called that you called the COVID law.
Well, that's you. I did. Well, before, I don't want to interrupt you on this, but I forgot to mention there's one thing in the outlook this week for U.S. shale that you need to worry about, and that's specifically coronavirus. When we started the show a month ago, 3 months ago, I got tired of every day saying oil's down because of corona. Well, guess what? That's really, since cases are spiking, that's the theme moving forward for the actual trading structure of how oil's looking. Corona. It's the law of corona. When cases go up, price goes down. It took me all of 10 seconds to come up with that. So someone hire me. I need a raise. Working too hard.
Absolutely. No, don't hire him. I need him. When you sit back and take a look, Moore's law was the number of transistors in a Intel chip processor will double every 2 years.
That's nerdy, Stu. I like it.
That was a long time ago. Now, so this is the Michael Tanner law, or Tanner law, however you want to call it. Price of oil is like beat up by COVID. Okay.
Yeah.
Next one, if you take a look at let me get over here. It is Total Petroleum has signed a new import with LNG with Sonatrach, and it is an Algerian national company bringing in LNG, and it is 2 million tons of Algerian LNG will land in France over each of the contract years. That's a lot of natural gas coming out of the other demand sections of area. So LNG is changing up in Europe. I thought all of that kind of blended all in together. So pretty busy week in Europe.
Yeah, no kidding. And you'll make sure to be following all of that on the international news desk. When we look at really the price and structure of oil this week, you can check it all out and check out my chart that I'm referencing on the Oil and Gas 360 News Desk, the best place. I mean, telling you, if you want a one-stop shop for how for what's going on in the energy market, check out the news desk. It's really the best way. But I'm seeing some massive structural weakness when we look at oil this week. I think we've really rolled ahead here, and I think moving forward, it's going to be choppy waters to see $40 again. When we kind of look at the 3-4 day span, I'm seeing a couple levels I like: 37.06, 37.81. 38.36 is the point of control for the past 5 days. So that's a really nice volume set. Currently, we're at 38.49. So that's sort of what we're trading at right now. 39.09 and 39.48. That's structure top right there. But I don't see us reaching that. If you're a price action guy, it flipped from bullish to bearish very quickly over the past 2-3 days, or over the past 4 or 5 days. We look moving forward. I'm bearish this week. I don't think oil is going to go up. And I think a lot of that's due to the structure, but also I think it's because COVID. I think we're going to continue to see some cases rise. And I don't even know if that's going to translate to hospitalizations. I'm not, we're not going to get into we're not going to dive into that debate because we all know we're having it with our friends. So we don't need to have it. We don't need to have the argument here, but cases go up. We're going to see this oil price continue to press. I'm on the short side for the beginning of the week, but as always, be wary of what my bias is. When we look at how the commitment of traders is looking, here's the biggest thing that I'm seeing is hedge funds are getting short. And that just signifies that people who trade crude oil professionally, whether or not you think they are good or not, they're all on the short side, meaning they think 38, specifically $40 is probably a top because this runs last Tuesday to Tuesday. This is definitely people shorting at that $40 level. We saw longs were cut by 2,000 contracts, 556 contracts on the short side lane. So that's a decent number when you talk about number of short sides, considering it's generally, we were talking about there's 426,000 contracts on the long side versus 56. So anytime you see a green for short and a red for long positions added, it means that hedge funds are definitely thinking that it's time to take out just a little more insurance. And with that, I think let's just go ahead and dive into the slaughter that was the 360 official, non-official fund last week. But first, before we say this, the lawyers make us say this so we don't get sued. This segment is for entertainment purposes only. Everyone on the show, i.e. me, Michael Tanner, and Stu Stewart, really invest for our own account. We do not manage any outside money. We do not give investment advice, and we do not offer securities or have any involvement in the regulated side of the industry. Remember, investing is risky, and you can and will lose your entire principal. I mean, I don't know. When are we holding the funeral? We got slaughtered last week, Stu.
This is going to be a short segment.
Yeah, it needs to be.
Yeah, and Tomcat is sitting on the corner, so he's doing well. My whole thing's red. Geopark is the only green one that I had. I love my
Bless
team.
Geopark. Bless Geopark. Go give them some. We'll give them some love. They're saving us.
Oh, absolutely. Geopark, good management, good numbers. South America. South America.
So Tomcat's sitting out, you said, though?
Oh, yeah. He's like, I guarantee
he's smarter than both of us. We getting hounded.
Oh, yeah. Well, the Tanner law is in effect.
No kidding. I mean, Bonanza Creek, we've now lost money on Bonanza Creek. They're trading below the price we entered at. We entered at $14.89. They're now trading at $14.05. They were over $22 at one point. It just kills me. This is why we swing to. So I've been saying for this past couple shows, or the last couple of Monday shows, but we're revamping this portfolio, and we may have to sling some stuff outside of energy to start making some returns here.
Well, hey, let's make a goal of a week from this Monday to have a new portfolio.
Hey, I like it. Well, not new. I like Bonanza Creek in the long term, but we need to add some much needed diversification to this portfolio and start making it look more like a hedge fund versus us just slinging stocks that we like.
There's a lot of, I'd like to throw this out there. There's a lot of small caps and mid caps that are no longer being covered by the analysts. So let's start talking about some of them and give them some love.
No, there's definitely a way to do that, and we'll be continuing to think about that. I mean, Stu, when we look at, I think we've had, I think this has been a really good show so far. Is there anything we're missing to get people ready for this week in oil and gas?
I think we're going to have a great week.
It's going to be great. It's going to be wildly busy, and by Friday we're going to be pooped, but you're going to be able to hear all of the recap on a Week Ahead podcast. With that, guys, I think we're just go ahead and let you guys get back to work and finish up your day. Thank you, guys, for checking out the 360 Digital Closing Bell here on Oil and Gas 360. We'll see you guys this afternoon for the Digital Ticker. Boom.
Very nicely done, Michael.